What's up, traders? Anthony Crudele here, and thank you for tuning in to the Futures Radio Show podcast. Welcome to today's FOMC panel on what to expect from today's FOMC meeting. And we're going to get the end of the year outlook and even into 2023 macro outlook for stocks and commodities. On today's panel, we have Andreas, Steno, CEO of Steno Research, and Macro Elf, the founder and CEO of the Macro Compass, and a man who needs no introduction, my friend and who's on the show with me every month, Morad Askar, founder of EdgeClear and otherwise known as Futures Trader 71. Today's podcast is sponsored by EdgeClear. Diversify your trading business with EdgeQX. EdgeClear offers a fully automated and fully transparent quantitative trading program. EdgeClear is excited to offer to their members this new automated trading strategy with full transparency to you, the trader. Quant trading has never looked better. More details at edgeclear.com/EdgeQX. Let me bring everybody in. Look at this group today. What's up, guys?
Hey, guys. All good?
Hey.
Everybody
it's more
good?
balanced than usual today. We have two slick-headed guys and two fully haired guys.
And I balanced it out too on the panel too. You got
I like
me
it.
and Elf. We got the Italians on this side, and then
the others.
yeah.
So liabilities and assets, or
Exactly.
Watch out. In Italy, we have plenty of assets as well. We can do good pasta, good food, and I think that's it. No, mostly.
You know what's funny, Elf? You put out a ton of great stuff and you get a ton of engagement, but I don't know that you get more engagement than when you post pizza pictures. I think that's tops.
So look, I mean, I told this to Andreas as well. I think I should actually launch a new line of business that is Substack for Italian food. I mean, this macro compass thing, yeah, it's good, but every time I push out my grandma pizza recipe, 4,000 likes, 5,000 likes.
We're all jealous.
Maybe my skills are in food rather than in macro, but Andreas is there to fix that. At least you can talk macro with him.
Yeah, I don't have any food pictures to post at least.
So guys, today is pretty much, it's the biggest day between now and the end of the year, right? I mean, and we were even talking before we came on today that you don't want to rule out something could happen at the end of the year, right? But this is really the day that everybody is, obviously eyeing. Yesterday was obviously a monster day setting up coming into today, and I think we'll probably talk about that first. I'm probably just going to go to Twitter because you guys put out so much great stuff on Twitter. And I'll share this in a second, but actually, Elf, yesterday you put out very interesting inflation numbers today. Let's have a look into the report. And I don't think you come into today without looking at what happened yesterday to kind of get your mind working to think about how that impacts potentially what the Fed does today. So maybe we start there.
Yeah. So I want to go back to what Powell said in his last speech. It's also one of the tweets in the thread. He basically, before I get there, actually I wrote only 2 of the 67 economists surveyed by Bloomberg expected this print. Bloomberg didn't survey Mr. Steno Larsen, but Mr. Steno Larsen actually got exactly the right figure. Now, Bloomberg doesn't survey him. I don't know why, but they should. But it was really unexpected, apart if you read Andreas. But it was a big surprise. What really interests me the most is understanding what the Fed will do, not what I think the Fed should do, but what they will do, which basically means what are they thinking about when it comes to inflation. And Powell told us that in his last speech. He divided inflation into 3 main categories. He said there is core goods inflation, there is housing inflation, and there is core services inflation ex housing. That's how he split the inflation categories. And why? Very clear, because core goods are basically all over the place. First, we had used cars growing 50% year over year, and now they are in deflation, right? It's all pandemic, supply chain driven. That's the core good stuff. So he knows it's going to be very volatile and actually disinflating rapidly going forward. You can see it as well in this kind of box there, that core goods, which were the top right, if I remember correctly. Yeah, used cars and trucks, for instance, over there. You see that they are very negative, purple color, which is like they're deflating effectively very rapidly at this stage. Then you have housing, and housing is important as a source of inflation. But Powell is not stupid, and he knows that housing, the way it's calculated in the CPI, lags what happens on the ground. Andreas also has done a lot of work on that, and you can see that this shelter month-on-month kind of inflation you're seeing now is simply the reflection of what happened in 2021 in the housing market. It's the way those are calculated. And Powell also knows that between now and I think April, May, you will see still these numbers being relatively sticky. They just lag what really happens in the rental market. So he knows that's not going to change much, basically, or he can't influence that straight away between now and May. What he wants to see coming down is the third category, and that's core services X housing. And now that's one chart that I put down as well there, and that's this chart. And this is the annualized 3-month change in this series, because Powell told us that that's what it's looking at. I'm not doing anything new, no groundbreaking. I'm just listening to Powell. And Powell said, I want to see 3-month changes, annualized, trending down. Okay. And this is the stickiest category he's interested in. Well, trend looks pretty interesting there. But if you dig a little bit deeper, you see medical services are representing most of the deflation in this thing. It's not in the thread. I limited myself, otherwise I'd blubber too much. Medical services are dropping month over month by like 4% for 2 months in a row. So they explain most of this drawdown. To me, the trend is clear. We are going to see disinflation going forward. I think inflation will settle at roughly 4% by summer next year, year on year, including core, maybe a bit lower. What happens after that, though, it really depends on wages and the housing market. I think both are going to suffer further. I think inflation overall prints at 2% by year end already.
Well, let's go to Andreas, who might have a little bit of a different thought process here, because I was actually looking at his tweet. You put this, let's see where it is, where you think about inflation. And you said, actually, why deflation is what you should worry about for the first half of 2023. So I think we go to this thread and talk to us about this, Andreas.
Well, first of all, let me define what I mean by deflation in the first half of next year. I tend to look at 3-month annualized inflation as the best gauge of what's going on right now, instead of looking at year-over-year measures. So in year-over-year measures, so the official inflation print, we obviously won't get to any negative numbers during the first half of next year. That's almost mathematically impossible, but we could get to negative territory, also in the category that Alf just described in core services during the first half of the year, in a 3-month period annualized. And this is a really interesting chart. If you take out housing from the entire consumer basket, we're actually now in deflation territory already now, based on the last 3 months. So we've seen an aggregate drop in prices outside of housing. That's including core services, right? So to me, that's a signal that something is happening beneath the surface here. The main driver of this drop is essentially goods. So we have a couple of categories now clearly dropping in price. Used cars is a good example of a good falling in price month after month right now. But also the healthcare part is actually contributing now to this deflation. So it's interesting that we have a couple of important categories now showing outright price drops. And I think if we look at the goods category overall, the chart just below the mouse right now, this one, I think it's fair to assume that we won't see any inflation at all, if not outright deflation across the board in the goods category into the first half of next year, as a consequence of supply chain easing across the globe. This is a chart showing the freight rates from China to LA, and they tend to lead the actual price of goods in Walmart and other stores in the US, simply as there is a time lag between when you ship products and until they actually reach the end consumer, right? So I think this is a very telling chart for what's going to happen with the price of goods during the next 6 months. The arrow points down, and if we go from a year-over-year level of 7.5 to a year-over-year level of 0 in 4 months from now, it obviously means that the price needs to drop in between. So I'm getting more and more convinced that we will actually see an overall drop in the consumer basket on a 3-month annualized basis towards the end of the second quarter in 2023. And that's, to me, a game changer for the Fed outlook, because they obviously watch 3-month annualized figures as well.
And before I have a follow-up for that and we get Morad into this conversation, I do want to ask you a quick question, just really about, I want to pick your guys' brain about energy stocks. It's a topic of conversation, obviously, a lot lately, energy stocks. What do you guys see with them right now? We'll stay with you, Andreas.
Full disclaimer, I'm short relative to industrials. Reason being that I find compelling evidence that the demand side is slowing quite dramatically in energy-intensive sectors. So everything from manufacturing to heavy industries, they report weak orders, rising inventories, and they also report that the end consumers, they now feel the heat from weakening purchasing power. So I think that's a cocktail that we currently also see in the physical commodity markets. I think it's hard to argue that oil is in an uptrend. Rather, it looks like the downtrend continues until we get a material bottom in the manufacturing PMIs, or the manufacturing outlook, basically. And I think that's going to happen sometime towards the end of Q1, early Q2, on my models predicting the manufacturing PMI. So we are still 3-4 months away from the bottom in energy prices, if you ask me.
Got it. What do you think about that, Alf?
Do you know what Putin is going to do?
No one does.
I don't. So I personally find it very hard to take views on something where the outcome can be very binary in a very short time frame, and without you having been able to have any decent edge on that binary process, which is literally the definition of energy during a Russia-Ukraine war. Although there are entry points and setups that can be, from a risk-reward perspective, very good, like the one Andreas just mentioned before. But honestly, I don't have a particular view. I mean, from a macro perspective, of course, energy in a disinflationary environment of lowering nominal growth and lowering inflation doesn't do well, historically speaking. On the other hand, it just takes the guy to do something that is completely out of whack, and then you're stopped out if you're short. So not particularly the setup that I like. It's a bit like being long China and then having the guys opening up the economy, and then all of a sudden having too many people in hospital because, Omicron, of course, doesn't have the same impact than any other variant, but because the numerator that it can hit in China is so large, at some point you might have a congestion of severe cases in absolute numbers. I mean, it doesn't take much to fill a hospital if you have 1 billion people. That's what I'm saying. And then they probably are forced to slow down a bit. The thing, what do I know the reaction function of Putin or Xi Jinping? To be honest, I don't have any particular edge there, right? So I tend to stay away from solely calling these variables, let's say.
Got it. Yeah, I mean, and that is right now still occurring, what's going on, in the Ukraine and with Putin. It may not be in the headlines every single day, but it is something that is actively happening, and you have to keep an eye on it. It's kind of been, thrown under a lot of other headlines. But it is definitely something you always have to keep in mind. But I want to follow up and maybe ask Morad. We heard their points of views and just some of the things that they're looking at on inflation. Mm-hmm. Morad, you and I we're not the macro guys. We listen to these guys, we read these guys, but we as traders, it's sometimes we have to just sit back. I know that a lot of times I watch what Andreas does, what Alf does. I almost have to read it twice just to kind of digest it and understand how I can use that as a trader. Right? Because, there's just a lot of information there. What did you take from what they talked about?
That I'm a shrimp and they're sharks, and I'm just eating whatever they drop to the bottom of the ocean. I mean, like the views on crude. I mean, I don't think Putin knows what Putin is going to do, to be honest with you. Fair. But, there's been a pretty decent bounce from the low here, and I'm a technical trader. I'm very, very interested in macro, and follow along very closely with the Macro Trading Floor podcast that you guys run, which I absolutely love. I mean, what other podcast can come on and do an analysis and actually have the guests throw out a trade. I mean, that's not done much in our business. So I follow those along pretty closely. But with crude, I'm looking at technicals, and in my time frame, I'm bullish on crude up to about somewhere around $90. Will it get there? I have no idea. My job is not to predict the future. My job is to take advantage of whatever the price action is now. In terms of inflation, it's really interesting that this 3-month annualized is showing housing, like I don't see the effect of this deflationary push because I'm just a man on the street, but I'm very interested to see what's happening with actual prices, like day to day, just going shopping, the price of food, the price, car prices, used car prices are supposed to be falling off a cliff. And I go look and it's like, no, it's the same price as it was 2 months ago. Where is this deflation? Can you answer that? Like, how does an individual, not an analyst, but an individual who has to deal with the micro environment that they live in, how does this inflation talk and deflation talk, how do we see it as consumers at the end?
So, and real quick before we go to those guys, I mean, you guys are in Europe, we're in the US. I'm just curious, and I've been to Europe since COVID, and I don't know if you guys have been to the US. I can tell you here, everything is just out of control. I mean, the food costs are just unbelievably high. In my lifetime, I've never seen anything like it. I'm just kind of curious what it's like on the in Europe. And maybe we'll start with you, Elf, because we just came off with Andreas.
So, Morad, I would say there that there was a chart doing the rounds in summer that looked at what's called the inflation of necessities in the US. So they looked at gasoline prices, food prices, heating your house kind of costs, right? The inflation of necessities on a year-over-year basis was running at over 25% at some point. 25% while wages in the US at best grew, I think, 7% year on year. That was probably the max. So just you couldn't even compete with that. So if your personal inflation basket is a low income kind of basket or low to medium income, then those necessities will cost much more, will have a much bigger weight in your own inflation consumption basket. So that's one thing to notice. Then the second is that Andreas rightly is talking about 3-month annualized changes because we are trying to infer what the Federal Reserve will be doing, right? This is basically the main task of a macro guy, almost nowadays, over the last 10 years, is to guess what the Fed will be doing. But if you're talking about the average person is looking at prices and has seen prices going up on necessities 25%. And now to see some improvement, he needs them to go down on an absolute basis. So year-on-year deflation in these things actually will take a lot of month-to-month weakness to turn into year-over-year decline, mathematically speaking. So a bit more patience, I would say, Morad. One more thing is that when such a sharp deflation happens on a 3-month annualized basis, it's mostly because the economy isn't doing particularly well. Every time inflation really dropped in the US over the last 100 years from, X% to X minus 5 or 6%, there was always a recession attached to it. This soft landing story where we drop inflation from 8% to 2% and everything is fine just doesn't exist in history in the US.
So I have a couple of points to add. I mean, first of all, let's look at the definition of inflation in the consumer price index, so the one we track, right? If inflation is at 0%, let's say that in April next year, it just means that we have the same sky-high prices as we had exactly 1 year ago. That is, to me, important to remember. And therefore, in the current environment, it is extra tricky to be a central bank, I'd say, because let's assume, if we take the European example, that we get a price drop in electricity. We currently have extremely high electricity prices from a historical perspective of 25% relative to a year ago. I wouldn't call that a true deflation because the price is still extremely high in a historical context. But yet the central bank will claim that now we've combated inflation, we actually have negative inflation in electricity and energy. So this is now time to cut interest rates and do QE again. I would strongly urge against that in such a case, because I would actually argue that it makes sense to get electricity and energy prices even lower. But in any case, you wanted a take on the situation in Europe. And let me use a bit of anecdotal evidence before I get to the true evidence. I think it was on Sunday, the contract for electricity between 5 and 6 p.m. in the UK traded at 2,500 sterling per megawatt hour. Is that a lot? Well, it was roughly 5 times the former record of a price for an hour of electricity. And it is, I'd say, in between 20 and 30 times as much as a usual price of an hour. So yes, we have a very, very tricky situation ongoing in energy.
Nuts.
And if you look at the average, I think it's fair to assume that the average household in the Netherlands, in Italy, in Denmark, where I'm from, is faced with an energy bill that is in between 2.5 and 3 times as large as last year. That's a lot.
So you probably shouldn't light up that Christmas tree. Just leave it the way it is.
That's incredible.
Yeah, it's amazing.
So I want to kind of go back to what you guys have been talking about with inflation and just kind of think about how it's setting up, not only for today, but I think what the markets are predicting that what the Fed may do. And I love going to, the CME Fed Watch tool. I think is the best tool for that. And I haven't looked to see what the rates, what they're projecting going into next year. But I guess my question is, does the Fed, because this is all about kind of guessing what they're going to be doing, does the Fed think that what they're doing is working? I mean,
yeah, I can start and then you can add, Alf. I think they know that monetary policy works with quite a time lag. So if they do something today, they don't expect it to work tomorrow, at least not on the sort of broad inflation picture, because from the point where you hike interest rates until you see actual layoffs, and they want actual layoffs now, there is probably a time lag in between a year and a half, thereabout. But they can impact inflation straight away, because I think, let's assume that they hiked by 200 basis points today. Then I guess your long oil position, Morad, would take quite a beating, right? And that would impact inflation today. It would impact the price at the pump. So they can actually impact inflation tomorrow via some of the traded channels if they are to aggressively move forward. But in the broad context of inflation, it takes quite a while before it actually matters.
So what I can add on that is, they think it's working. They are not happy with the results so far, so they want to do more. They want households to go through some pain, quote unquote, Jackson Hole speech by Powell himself. And that also means that despite the initial evidence that we are getting that inflation is slowing down, until Powell sees that the labor market is showing cracks. Cracks doesn't mean adding 270,000 jobs a month on a trending basis. That's not cracks. That's still pretty decent, if you ask me. We need to go to job losses. We need to have non-farm payrolls quickly trending to zero, I think. And on top of it, inflation continuing on this downward trend to make Powell more comfortable that finally the lag has finished and he can see the effects of what he has done. The reason why he wants to be so conservative, he told us plenty of times that Volcker made one mistake in the 70s, which is to ease up a little bit. Andreas put an amazing chart on Twitter that shows that, basically in the 70s, they tried to fight inflation. They thought they had won the fight. Then they eased up a bit. And then you had a massive second leg up in inflation. And because Powell has been so damn wrong about inflation in 2021, saying it's all about used cars, don't worry, it's fine, he has been caught off guard. He definitely does not want to be caught off guard again by saying, hey, at the first instance of inflation slowing down, I'm going to ease my policy. He's not going to do that. He's going to wait for evidence. And evidence that he has done damage is that wage growth slows down. For wage growth to slow down, you need people to get fired. And it's not nice to hear, but that's what is it up there. I mean, There is the amount of people that are employed against the vacancies, although it's not my preferred metric because vacancies are a bit overstated because of our new economy, but still, this imbalance is still too large on a spot basis. It needs to be corrected for people to have lower wages.
Can I ask you a quick question to both of you? Where do you place the JOLTS number? Do you pay attention to that at all? Because it has remained very sticky in the 10 to 11 million openings. How do you read that? Where does that fall into place, if anywhere?
Andreas?
Yeah, I've done some work trying to figure out how often it happens that the same job is posted in 3 states, for example, right? So I think there's a lot of double counting going on compared to pre-pandemic levels in the JOLTS report. It's very tricky to calculate the exact true number of job openings. It's certainly high, but it's nowhere near plus 10 million level. And the reason is that if you are looking for a, say, backend developer, you could just as well have the same job posted in California and New York, right? It doesn't really matter if you post a job that is an adequate remote position, basically. So I think that's what's going on, and that's why it's very tricky to use it right now. It's easier to look at these numbers in the European context, since we basically separate the numbers on a country-to-country basis. They don't do that in the BLS.
So a remote job that's listed in 3 different states is counted 3 different times potentially?
It could be, because what they do is that they call Ernst & Young and ask them how many job postings they have. So it's basically survey based. So if the HR department of Ernst & Young considers the same job to be 3 jobs, then it would be double or triple counted.
It's a bit like the Bureau of Labor Statistics non-farm payroll against the household survey. In the household survey, 1 job, 3 jobs is 1 job. It's the same person being employed or not. And for the non-farm payroll statistics, if the same person has 3 jobs, America just created 3 jobs.
3 jobs.
Wow. Yeah, so it's a very similar. Yes,
I didn't know that.
Yeah, and that's very funny. I mean, there are so many statistical inconsistencies between the 2 surveys, and the fact the pandemic has also messed up the labor market statistics massively. There is an estimate that the non-farm payroll survey does on so-called net birth death of businesses. So they basically estimate how many new businesses are supposed to be born in a certain period of time on a net basis in the US, and therefore how much employment they create. And they take that number and add it to the number that we read and the numbers that move the market, right? Now, after the pandemic, the models probably are not working at the full capacity, because every single month, the US is now estimating the net birth of business in the US is double what it was before the pandemic. Every single month, we all of a sudden create double new businesses that we used to create before the pandemic. That is a bit suspicious, if you ask me. And it's also pumping up the number in the NFP because, again, more business created supposedly create more employment, and this estimated figure is then added to the non-farm payrolls. Also helps explaining why the difference between the 2 surveys is so large. The household survey says basically not many full-time jobs have been created of late. Non-farm payroll says 270,000 on a trending basis. Probably the truth is somewhere in the middle. Just to say one of the statistics, why it's important from a macro perspective to go and look a little bit beyond these numbers rather than just focusing on the headline. But I forgot what the question was. Geez, I'm becoming old.
You're thinking about pizza.
Pizza? Yeah, I can talk about that. No, but I don't remember why we were blubbering about 3 jobs and a word job.
I don't remember either.
Just how the JOLTs are being counted. And how
that was the question.
Into non-farm payrolls.
On JOLTs, I would say that the hires actually are a good figure, because you can have 3 job posts across the country, but then you will make probably 1 hire remote amongst these 3 jobs. So there is the hiring component of the JOLTs that does a decent job in predicting non-farm payrolls with a 3 months lead time. So I tend to look at that on a momentum basis to see, how many people are getting hired from the JOLTS figure rather than job postings, because as Andreas says, that can be a bit overstated.
So we're going to take a quick break, and because Morad, we have some stuff to give away This month is our last show of the year, and we are giving away what?
We're giving away 4 Edge Pro X licenses for 6 months. They're worth, what are they worth? About $220, $250 each. And we'll spin the wheel here after we come back, right?
All right, yeah, we're going to take a quick break. Let us get a sip of water. We're back in 30 seconds to spin the wheel. But when we come back, I want to ask Alf and Andreas, not only are we going to see the winners of the spinning of the wheel, which is always fun, why the Fed always seems to go to extremes. Raising rates, lowering rates. I think it's something that's interesting. We asked them if we thought that the Fed thought that if the Fed was convinced that they were doing the right thing. I want to see what these guys think are doing the right thing. Then we're going to get best guesses for FOMC, what to expect from today's meeting, what to expect for markets to react to. I mean, that's the one thing about having these two guys on is that we're going to talk about what we think the market could potentially do based upon some scenarios. So back in 30 seconds.
Streamline your trading setup with Edge Clear, the forward-thinking broker for active traders. From our unbeatable service with an assigned broker to Edge Pro X, our robust and reliable trading platform, Edge Clear offers more than transparent fees and fair prices. Designed by traders for traders, we combine the best of technology, service, and risk control. Our dedicated brokers are here to help you grow. Join Edge Clear today and elevate your trading business.
All right, we are back, everybody. Morad, do we have the wheel ready?
Yeah, let's roll. Sorry, I should have pulled it up. It's not giving me the ability to select the desktop. Here it is. Share screen.
We'll use, if we don't get it, we'll take your word for it, but we want to make sure, me and Alf want to make sure it's Italians that win. That's kind of the way we roll.
All right, here's the wheel up. And we're gonna spin it 6 times. 4 winners, 2 runners up. Don't want to do 8 because it just takes too long.
Oh, we got a lot of people signed up again.
Yeah. Paladin is the first winner. We're gonna hide that one. Spin it again. And Ropar.
I swear I'm waiting for an Italian name. So that
there are always a lot of Italian names in this thing.
So that I can pronounce it. I mean, that's all I'm hoping for.
A lot of Italians in finance. Max Maxwell. Wow.
Let's get 2 first names.
That's a familiar one there. And then this is the 4th winner.
Come on.
Paisano. Bierman, no.
This is more a paisano of Andreas, who likes beer a lot, I can tell you.
Bierman 68. And then these are the runners-up, so we're going to hide those 4 winners, and we're going to go for a runner-up, just in case they can't claim it. Mokasha.
Remember, everybody, as he does this every single month, we're giving away something. We're always the last Wednesday of every month, not this month because of Christmas and everything. But you can go to edgeclear.com/deli, and you can sign up for our giveaways each and every month. So
there you have it.
That's what we did. And Morad, it's always great. Like I always tell everybody, go and check out what Morad's got going on. You can go to edgeclear.com/deli. It's great to be back with the guys. And so the first question I want to ask you guys is, it's kind of a follow-up. I asked you if you thought if the Fed believed what they were doing was right. Do you guys believe what the Fed is doing is working?
I'm going to throw Andreas under the bus first.
Let's go, Andreas.
Well, it kind of depends. If we take a step back and look at what happened over the past decade in monetary policy, I'm probably in the camp that finds so-called quantitative easing almost irrelevant for inflation. I think it's very clearly a part of the reason why we have such elevated asset prices. But I think the reason why we have elevated prices in the real world now is because of financial policy during 2020 and 2021 mostly. It was when Donald Trump and after that Joe Biden started sending checks to each and every household that inflation really started rallying, right? So I don't think QE and QT is particularly effective when it comes to targeting inflation. Interest rate hikes, as they're currently pursuing, they will work, but it's very tricky to figure out how much to do and for how long, because you only get the evidence 1.5 years late, right? And therefore, my best guess right now is that they've done too much. But again, it is a guess since we don't know the bottom line until 6 to 9 months from now. On my forward-looking indicators, we are staring at a relatively grim recession in the first couple of quarters of next year. If you look at interest rate models trying to predict purchasing manager indices, I think we would trough at least below 40, maybe even as close as we get to 35. So very low levels in the PMI. Unusual correlations between interest rate hikes and the subsequent moves in purchasing manager indices. So my best guess is that they've done too much. I think that would be my bottom line. And I don't consider balance sheet policies particularly compelling as a way of moving the needle in an inflation target.
The Fed can only extinguish a fire. It can't start one when it comes to inflation. I agree with Andreas. Who started the fire here is not the Fed, but it's the government of the United States by giving away to people $5 trillion with an Italian accent. It even sounds better. $5 trillion. So this is not some funky financial bank reserves. It's literally money on our bank accounts, right? Literally, that you can go out and spend. You didn't have that before. Obviously, the Federal Reserve helped accommodating this process via quantitative easing, but the bonds issued by the government would have easily been bought by banks or pension funds or asset managers. I mean, as long as there is a regulation that is helpful, these bonds can be bought by these entities. The Federal Reserve eased the job, but it's the government who took the decision to print $5 trillion into the bank accounts of people, literally. So I agree with Andreas. The fire was started mostly by the government of the United States, and the Federal Reserve threw some oil on it, basically, to lighten up a bit higher. And the biggest mistake is that the Federal Reserve can extinguish the fire. So if the government doesn't keep printing money, and they are not, they stopped. In April 2021, they stopped doing large fiscal stimuluses. So it's been almost 2 years now since the last round of fiscal stimulus. The Fed could have extinguished the fire earlier, and that's the mistake they have done. They've waited way too long. Then they freaked out. And why they freaked out? Because it's an incentive scheme problem. No central bankers want inflation at 8%. It's way above their mandate. Their credibility is at stake, and credibility is everything for a central banker. And so what they do is they don't react linearly anymore. They just go ballistic, and they raise Fed funds at 5%, and they do quantitative tightening at the same time. Obviously, it's going to work with a lag, and it's going to show that clearly they did too much. They extinguished the fire too late, and then they went too fast on it. So house prices are going to drop 25% next year, which sounds like a scary number, but only brings us back to early 2021, mid 2020, as kind of house price number. But a lot of people are going to be underwater, and they brought during the mania, they're going to be underwater. Unemployment rate, hey, Mr. Steno.
Yeah.
Unemployment rate, it's going to be 6.5% in 2024. A lot of people are going to lose their job next year and in the next 18 months. Tighter financial conditions work slowly. Companies have their borrowing rates doubled, basically, literally. All of a sudden realize they cannot lever up their balance sheet and pay nothing with it. And then after a while, they will decide to cut costs. And first they cut discretionary spending. Then they cut a bit of investments. Later on, the only thing they can cut is labor because the economy is weakening. And that's what's going to happen next year. So next year, you're going to have an economy that is a reflection of the incredible tightening in 2022. Exactly like in 2021, you have a booming economy, which was the reflection of the massive stimuluses and easing of financial conditions from the Federal Reserve and the government. It's just the same thing rolled on the other way around this time. And I'm not sure why people don't expect the drawdown as harsh as the incredible spike in economic growth we had in 2021. It's just the other side of the coin.
So can I jump in here, Deli? Just as a trader looking at the market every day, even if the Fed stopped, so there's some talk of 25 basis points today, probably not 75. I think the probability on the Fed watch tool is like 20% currently.
Yeah.
And so even if they stop today and they hold here, why is this such great news for the market that the S&P will rip up another 200 points and trade at 4,300, potentially 4,500 because they've slowed down? You still have businesses paying twice for those loans, twice as much for loans. You have people paying double the mortgages for homes that they buy today or whatever it is. Why is this something that stocks should benefit from if it stays the same? It's like Andreas said, at 0%, it just means that it's really high and it's just going to stay here. It doesn't mean 0%. It goes back to zero. So what changed? Why is it that the market's so reactive? You two being institutional, former institutional traders and managers and so on. Why is this good for an institution to go and dump a bunch of money in the S&P or the NASDAQ or whatever index just because they say, oh, we're going to slow down a little bit? Why is this good news?
Well, first of all, a disclaimer, I'm leaning short. So I agree with you that it's not necessarily good news. But I guess the reason is that the market could see this as an early hint that we will get new liquidity from the central bank at some point during the second half of next year, maybe. As soon as the market sniffs out a potential for QE, we've seen how the animal spirit sort of resurfaces, right? And I think that's exactly what's going on right now. I wrote an article a couple of months back named 3 reasons why everyone, my dog, myself, Mark Zuckerberg, became financial illiterates due to zero interest rates. And I still think we suffer from that period in time, because at zero interest rates, as we had through 2020 and 2021, basically everything made sense. All of the financial models that I'm born and raised with in a professional setting in investment banks, they just tell you to buy everything at no matter the price, if there's a chance of a cash flow before the end of the world, right? As long as interest rates are zero. And I still think we suffer from that mindset because it's very clear as soon as we just get one decent inflation print, was it a month ago, we got an inflation print and NASDAQ jumped almost 8% on the day, right? It shows that the animal spirits are still there. And frankly speaking, I think the Fed has a job to do in terms of ensuring that those animal spirits, they don't resurface as soon as they step off the hiking cycle. Because if animal spirits are back as soon as they stop hiking, then I fear this double top inflation picture that we talked about from the 1970s.
So
I just want to say something real quick, but I got to tell you what, the way you put that is exactly the way that the market is telling us. It's the bad habits that keep surfacing, and until those bad habits are trained out of people, it's going to continue to happen. Yeah. So people, out there, traders chase that, thinking that this is the moment, it's coming back, and then this is why we continue to struggle. So sorry,
I made a meme a couple of months back with Jay Powell saying, I'm going to hike interest rates until you morons stop trading monkey JPEGs. And I think that's spot on what you just said.
So, Kelly, I have to say, I really agree with your take. I want to go back a bit in history and go to 2001, when the Federal Reserve cut rates by 475 basis points. 475 basis point cuts in 15 months. A pivot, okay? Not moving from 50 hike to 25 hike to cut by 475 basis points, okay? Just to give you context.
That would put us negative today, right?
Yeah, that would be basically from 5% and Fed funds, let's say in February, to basically zero somewhere in 2024, okay? So that's just to give a bit of context before I go ahead. In every recession, the Fed has cut 300 basis points in 12 months and 400 in 24 months. That's the average cutting cycle of the Federal Reserve in a recession. That's a pivot, not cutting 50 basis points. That's not a pivot. said that in 2001, the Fed cut by 475 basis points in 15 months. And if I would ask you, what was the S&P performance in 2001? What would you say it was?
If I remember correctly, it was lower, right? Because that was 9/11.
In 2001, the S&P delivered minus 12% total return.
Yeah.
I want to repeat that. The Fed had cut rate by almost 5 percentage points. The S&P returned negative 12%. And why? Because earnings were collapsing. And so it's not as easy as Fed pivot equal, let me buy the hell out of it. Obviously, in this drawdown, we had plenty of 20% rallies. The Nasdaq, till finding the last bottom in 2002, rallied 20% for 7 times. 7 times there was a new bull market in the Nasdaq in 2001 and early 2002. And it only bottomed 15 months later. So this muscle memory that Andreas is talking about, right? We are basically trained for the last 10 years. Everything that smells like a pivot means we need to close our eyes and buy the highest beta assets out there. Anything that there is. ARK, Bitcoin, S&P, Nasdaq, just give it all to me, right? That's how we used to think. And this might be actually the initial reaction we get. That's why I'm very hesitant in being outright short, is that if Andreas and I are right on this inflationary theme, even translating into a weaker labor market, people are going to buy stocks on this because they're muscle trained to do this. The Fed cuts rates, I buy stocks. Only later they will realize that the Fed is cutting rates because the economy is shit and there is nothing to be happy about, and earnings are going to drop 30% and house prices are going to drop 30%. But it's going to take a while. So this muscle memory is going to be strong. And as a tactical investor or a trader like you guys are, it's really important to understand that it's not about what we think the market should do, but it's what it will do. In the first instance, they might as well buy stocks. That's why right now as a trade, if I think it's disinflationary right here, I'd rather buy bonds. I think 2-year rates are completely mispriced if Andreas and I are right on growth and inflation, because I know that ultimately the Fed will be forced to cut rates because the labor market is weakening, because inflation is coming down. That's a fact. How equity investors are going to take it because they want to go and chase the S&P higher in the first leg, I'm not sure whether they will do that or not. So I'd rather be long bonds than short stocks at this point, if I know what I want to say. From a risk-reward perspective, it sounds to me as a safer midterm allocation to buy front-end bonds in a disinflationary environment, because equity investors can surprise you. This muscle memory can be very, very strong.
Yeah, I mean, stocks can be psychotic, man. I mean, it's just reality. There's just nothing you can say about it.
I'm about to tweet because there is this story of 25 basis point, right? I mean, if Powell today does 25 basis point, I can guarantee you the S&P is 4,500 in 3 days.
Yeah, I would agree with that.
You can quote me on that if you want. If he does
so
25 basis point, we go to the moon, straight to the moon, straight away. All the people that are still short, it's the 14th of December. Imagine you are a manager, a hedge fund manager, or somebody in institutional business paid a bonus on your performance. Imagine you're short and the guy hikes by 25 basis points. You cannot fuck up your bonus because you were short on the 14th of December. You're going to go and chase this thing higher, whatever the price is. And this is how it's going to be really in the first leg, which sounds very stupid, but that's probably what's going to happen.
Yeah, I mean,
but he's not going to hike by 25 basis points. There is zero chance, if you ask me.
Yeah, and that old high of 43.30-ish in there on the futures, if that gets taken out, I mean, I easily could see a 44 or 4,500. I mean, the way that this market's been. But because we're running short on time, and you guys are so gracious with your time, I know we've got some questions in chat. Everybody, please put your questions in chat. And if you're enjoying this show, please give us the thumbs up and share the show, because these guys are great. We really appreciate them coming on, and we want more and more people to tune into the show. What I want to go is to you two guys and get your final thoughts about what we're looking for today. I think we're all kind of thinking 50 basis points, but I mean, we'll start with you, Andreas. Just walk us through what you're expecting from the Fed and what are some things that we should be looking for within the statement.
Well, I think we need to watch the wording around inflation. Since we have pretty compelling evidence that inflation is moving towards the target now, at least from a momentum perspective. And on a 3-month annualized basis, we even have some important measures printing below the 2% target now. So this is the key now. Is it even a feasible possibility that they will hike 50 basis points today and then conclude the hiking cycle, either with a 25 basis point hike early next year or conclude it after today? I'm probably leaning towards that they will do nothing outside of this 50 basis points hike today. And I guess we will get early clues on whether I'm right on that.
Alf?
Parting words. My parting words are that Powell hikes by 50 basis points today, that the dot plot keeps showing rates peaking at 5.25% next year, so pretty elevated levels, that they revise up their unemployment rate forecasts. So they tell people we are very comfortable, by the way, with unemployment rate going up. I think they want to send that message. And when asked about inflation, he has to try and highlight that this is only a minor improvement, that if you look under the hood, it's medical care services, it's core goods, and blah, blah, blah. So he's going to try to defend it. I am not sure that he will succeed. I'm not sure, because the market now smells what Andreas is discussing. They smell this inflationary trend, and they are muscle trained to buy credit spreads and bonds and equities and everything when they see these trends emerging. And Powell clearly doesn't want that, because then it's animal spirits coming into play again. But will he be able to hold his ground and defend his hawkish stance? It's pretty tricky at this stage. He needs to come up with something very strong. I am not sure that he will. So I don't like binary outcomes, but on the margin, I would expect that he doesn't materially succeed in out-hawking the market and scaring them away. He will try, though. He will try. Pretty sure about that.
But one thing I would like to add to that, Alf, is that they've at least made their intentions clear in terms of where they want the Fed funds rate to be at for a prolonged period of time. They want to take it to 5 or thereabout, and then they want to keep it there for a prolonged period, right? And I consider that completely impossible, just because I know how central banks work. They are constantly asked for a direction from right about everyone, including politicians. So are we going in this or that direction? So you cannot plateau for more than 3-6 months. It's simply just impossible due to the external pressure.
Yeah. You can also see the bond market. The bond market is saying Fed funds at 5% for the next 4 to 6 months. That's all I'm going to try and allow you guys. And after that, you'll be forced to cut. The cutting cycle priced in there is not a recession cutting cycle, by the way, because I'm hearing a recession is priced in the bond market. No. A recession means 400 basis points of cuts. Those are not priced in. It would be weird if a market would price 100% probability of a recession. That's a stupid thing to do in the first place. But by my calculations, as released on the Macro Compass, we're pricing anywhere between 30-35% of a recession in the bond market. And in the equity market, not much, to be honest, of a recession is priced in at the moment. So let's see what Mr. Jerome... I hope they ask him about the yield curve, though. I want to see him saying with a straight face that the yield curve isn't inverted, because that's what he said last time. The 18-month, 3-month minus the 3-month is not that. Now he can take any curve slopes he wants, anything. He can take them all, and all of them are going to be inverted. So let's see what he says.
It's not inverted. It just looks like a hockey stick or something.
Oh, you're right. No, I think if you invert yourself, and put yourself bottom up, then
just turn your head sideways. You'll be fine.
It's been a pleasure, guys.
All right. Well, I just want to go through. Well, thank you guys for the final notes. We got a few people that are always in the show, always asking questions. I think that we did answer a lot of them. Aaron talked about, do you think there's a chance that inflation environment returns rather quickly as the Fed rate hikes slow down? I think we've pretty much answered that throughout the conversation today, right, guys? I just wanted to make sure that they know that I am seeing those questions and I want to bring them forward. What about paycheck protection program that went to companies? I think that's kind of touched base on what you guys were talking about as well. And then this is another question I just wanted to pull up from Jim, who's always in the shows, and we appreciate you coming in here, Jim. Anthony, great show. In the opinion of your guests, which leading economic indicator is giving false readings that the Fed could be overlooking? And maybe we just leave on this question. Do you guys, is there anything out there that maybe the Fed is overlooking?
Well, to me, the most interesting economic indicator right now is consumer confidence relative to business confidence. That spread is historically wide. It's even worse when you look at Europe. And to me, that's a really tricky thing to gauge for a central bank. So they could be overlooking that spread on purpose, since they probably explain it away with post-pandemic effects, etc. But I don't think you should underestimate the importance of consumers telling you that they don't intend to buy anything at all over the next 12 months. And that's essentially what they tell you if you ask them.
Housing market, but that's not that they're ignoring. They're very happy to see the housing market coming to a freeze. That's literally where we are. There are no sales anymore, 40% down year-on-year sales in America on average in certain states. Every time the housing market has come to such a sudden freeze, unemployment rate 12 months later has picked up pretty materially. And it makes sense because the housing market represents 15 to 18% of GDP in the US and employment, including ancillary activities, brokers, construction companies, etc. Hey, if there is no sales anymore and no turnover anymore, guess what? Some people are going to lose their jobs. So the Fed is not overlooking it. They're mentioning it pretty rarely, but because if you ask me, they're actually very happy about the freeze in the housing market because it's going to help them weaken the labor market. But it's an important thing. It has an impact on many people's balance sheets, right? I mean, housing mortgages are sitting on any of us balance sheets. So I just wanted to point that out.
Yep. And before we let you guys go, the macrocompass.com, we got Elf here. Go follow Elf on Twitter at macroelf. I'm sure most of you guys do. He's one of the best follows out there. And I know you have something going into year end. I will be a subscriber to it because I think your work is fantastic. Elf, maybe just give everybody a quick overview of what you got going on at the Macro Compass.
Oh, thanks, Deli. Appreciate it. So the Macro Compass is my macro research platform, but not only that. So what I'll be doing there is giving away macro pieces, but also trade ideas and a fully replicable ETF portfolio for people that prefer that as an investment vehicle rather than tactical trades, and also macro tools. So people will be able to play themselves with exactly what I see on the screen every day and try to come up with trade ideas and screen the market basically like an investment professional would do. That's part of the offer. Different tiers for different pockets, depending on what you want. Everything on the macrocompass.com.
Yeah, I'm going to be in that middle tier. I was reading what you got
Fair
going
enough.
on. Looking forward to that. So, Andreas, you as well, talk to us about what you've got going on.
Well, I'm launching my own research shop 1st of Jan. Already hired the team. We've onboarded a couple of handfuls of institutional clients, but the sort of broader package will not be live until January. So stay tuned on my Twitter page or at my Substack. You will find more information. I can guarantee you that I will be a bit more Eurocentric than most other research houses. Since I'm born and raised in the northern part of Europe, I've traveled the world to meeting institutional investors speaking about Europe. So I think Europe will be my main focus just because of that. And I can guarantee you that a lot of stuff is going on in Europe right now, not least when it comes to energy. So if you want to understand what's going on in energy, you need to understand what's going on in Europe. And I'll make sure that that I'll cover that.
Yeah, you do an amazing job. I love your Twitter feed. It's fantastic. It's at Andreas Steno. I really love your stuff, and I look forward to what you got coming up in January. And of course, for you guys tuning into Morad and I on Futures Radio Show every month, go to edgeclear.com/deli. You learn more about EdgeClear there, and then you can sign up for what our giveaway will be in January. We haven't released that yet, but definitely go there over the holidays and get signed up as we start to come back in full force in January. Everybody trade well today. You know, you don't have to trade a Fed day. Sometimes you just sit back and watch, right? I mean, watch these guys what's going on in Twitter, right, Elf? I mean, see what's going on.
One last word from my end. My mentor always said the most complicated skill of a trader or a tactical investor is to do fucking nothing. Literally nothing. Just wait for a good setup where the market is mispricing some probability. Go into that. For 90% of your time, you should do nothing. That's what he said to me. He was a smart
But there are
guy.
so many blinking lights and
I know,
numbers and
they
math.
look
There's so
good.
much math.
Yes, they look good, but it's difficult. But he was right. At least his track record was very, very good. So I tend to listen to what he told me.
Yeah, watch these guys on Twitter, see what they're saying first. Be patient on days like today. Watching is learning. I mean, for me, this used to be one of my favorite days to trade, and now I barely even trade it because, you can't chase a 200-point move in the S&P. It's just impossible, and you don't want to be one faded either. So, everybody, this is the last Futures Radio show for the year. I want to wish everybody a very Merry Christmas and a Happy New Year. Thank you so much for tuning into Futures Radio show throughout the year, and it's so great to end on this note with Alf, Andreas, and Morad. And so I just wish all of you, just like I said, a very Merry Christmas and a Happy New Year. And thank you so much for tuning in, guys and girls. And thank you guys so much. I really appreciate you guys coming on. This was great. I'll see you. Cheers, everybody. Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a 5-star review on iTunes. Never miss an episode. Go to anthonycrudele.com and get on our email list for show notifications and for free content that is exclusively for subscribers. Also on anthonycrudele.com, you will find tons of videos and education on trading futures, options, and crypto. Past performance is not indicative of future results. Opinions expressed are solely my own and my guests, and they do not express the views or opinions of my sponsors. Futures Radio Show is produced by Crudele Productions.